I recently came across a very insightful article which I thought laid out a very simple yet convincing explanation of the outlook for the global economy and markets. It was titled The Three Gluts and was written by Joachim Fels, who works for PIMCO, a global investment management firm headquartered in California with almost $1.6 trillion in assets under management. According to Fels, the global economic outlook is driven by the interaction between what he called the three gluts: the savings glut, the oil glut, and the money glut. The global savings glut was a term coined by ex-Fed Chairman Ben Bernanke over a decade ago to describe a situation where an excess of global savings over global investment depresses already low long-term interest rates. But why would it be that everyone wants to save more but nobody wants to invest? Fels suggested 5 main reasons. The financial crisis of 2007-2008 cast a long, dark shadow over consumption, savings, and investment behavior. People want to or have to save more for a longer retirement period, as the retirement age has not risen along with life expectancy. The rich save more than the poor. Many new industries have low capital needs, and those that don't have trouble convincing investors to commit their capital for a long time. Emerging market countries have aimed to reduce their capital imports and slashed investment spending following the so-called taper tantrum in the United States in 2013. Due to these factors, the global economy has been suffering from a deficiency of demand, both on the investment side and the consumption side. If governments fail to fill the demand gap with fiscal stimulus and central banks cannot push real rates significantly negative, the economy will become lethargic and central banks will have to allow the growth and proliferation of speculative financial bubbles in order to avoid even worse outcomes. The second factor, the oil glut, which became so apparent in the second half of last year, actually helps to mitigate the depressing impact of the savings glut on consumer demand. It does this by shifting income from oil producers, who have a high propensity to save, to consumers, who typically spend most of their income. For a net importer of oil like the United States, the immediate negative impact of lower prices on investment in the oil sector is eventually outweighed by the positive effect on consumer demand, once the lower price of crude oil translates into lower gas prices at the pump. The third of the gluts, the money glut, is fueled by the impact of both the savings glut and the oil glut on central bank policies. The savings glut has forced central banks to try to push real interest rates lower by means such as zero or even negative policy rates, forward guidance, or quantitative easing. And the oil glut by temporarily depressing inflation, and more importantly, dampening inflation expectations, has led to a doubling of this effort. The global money glut, which was already increasing due to recent asset purchase programs put into place by the European Central Bank and the Bank of Japan, will likely only increase as China starts to ease its monetary policy to forestall a decline in growth. Fels concludes that as a result of the combined influence of the three gluts, global growth, inflation, and interest rates will remain much lower than in previous business cycles, reflecting the outsized impact of the global savings glut. Secondly, he suggests that there will be a pickup in global economic activity and inflation over the next 6 to 12 months, reflecting the combined influence of the oil glut and the money glut. And finally, he expects US bond yields to rise moderately from current levels on the back of the recovery, and in response to the Federal Reserve's embarking later this year on a long, albeit shallow, path towards a new benchmark interest rate around 2%.